Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the TGI. Thank God it's Friday, the 10th of June, 2022. Bull versus Bear webinar. Steve Miley on the call here for Trade Day, tradeday.com. Welcome, everyone. Now, first of all, just a bit of housekeeping. We are all up and running fine as far as I'm aware. Last time I checked. Everything is working with the site in accordance. Very much appreciate your patience, guys. I know for those of you on the evaluation challenge and the 14-day free trial, there probably been not too many issues. If you're on the evaluation challenge, you've certainly had issues with your dashboard. They should all be correct and update for 99% of you. I know there's I think one or two of you who maybe have just slight issues that are being dealt with specifically. But most of you now should have your dashboards in place and all looking as they should do. Apologies if you've had any issues over the past week whilst we've dealt with what's been our kind of our first really big major technology issue since we launched Trade Day pretty much late last year, beginning of this year. So thank you for your patience. Apologies if it has caused any issues for you once again, and we should be all fine. If there are any issues you are still encountering, please do email in to support@tradeday.com, and we will deal with those as rapidly as we can. But as far as I'm aware right now, everything is okay. And the other thing I wanted to say in here for the webinars is, just to say, and also welcome to any new signups. We had to, whilst we were doing the work on the site, we had to pause our trial period, so no one could sign up for the trial. And so, yes, welcome if you have just started on the trial period, on the 14-day free trial. For anyone who has been waiting to get on that over the past week, again, apologies for the delay in not being able to get on, but we had to suspend it while we sorted out the technology issues. Now, the other thing, the final thing before we move on with the webinar in earnest, just to say, if you do have questions, right, if you do have questions you want answered, if you want me to go through something, if you want me to go through something on technical analysis, if you want me to go through something on macro fundamentals, economics, whatever it might be, correlations, I don't know, whatever it is to do with the markets, if it's really basic questions about futures, if it's basic questions about indices, I don't know what it's going to be, right? Please do fire the questions either in, or if you want, live in the chat. I mean, I've done these webinars before and had far more engagement. It's much better if we get engagement. I do appreciate it. Probably a lot of you watch this on the catch up and don't watch it live. If you do watch it live though, then please do pop questions into the chat if you want. I'm looking at the chat right now, waiting for something to pop in, and nothing's popping in. But the chat box is just below where the webinar streams in the members area. So if you want, pop a question into the chat and say, or even if you want to just say hi, it'd be nice just to say hi. So and then that means a more interactive webinar means more value for you and for all the other users as well. Okay, let's run through what's going on in markets right here, right now. I'm going to start off with actually looking forward a little bit, really. So CPI, it's all about CPI today, obviously. It's the most important data we have now of the month. With inflation front and center in focus, probably more important, certainly I think more important than the employment report now. So we're going to have to wait and see, right? And if we go take a look at the calendar on expectations in here, this is the investing.com calendar. We have the month-on-month data looking to come in at 0.5 with the previous at 0.6. And this is coming up in now 55 minutes time, just under 1 hour's time in here. So we're talking 8:30 Eastern, that's 7:30 Central. And in the UK here, 1:30 if you're in Europe, 2:30 or whatever time it might be, wherever you are on the planet. So we have the month-on-month data, expectation 0.5, previous at 0.6. The year-on-year 5.9, previous at 6.2, and that's on the core readings. And then on the normal readings in here, we have year-on-year 8.3 and the month-on-month at 0.7. So we're going to be watching out for those going into today. They're going to be critical to how the market moves. At the same time, we also get Canadian employment report. I don't see that having a big impact. Now, later on today, yesterday, I think there's been, some lazy journalism going on in here. If I go and take a look at where are we, like the recaps from yesterday, Wall Street drops. This was from yesterday. We had a fairly significant sell-off yesterday. It's all looking fairly healthy as we went into the pre-cash market open, but we were on the call when the ECB came out. And obviously, as I said, when we were on the call, we looked at the price action. European markets initially did a little spike higher in the first minute after the announcement and then went lower. Euro ended up going significantly lower, and bond yields in Europe went significantly higher. The bond yield spread, the US versus Europe, is widening out. Okay, so that means that Europe playing catch up. Okay, the 10-year bond yield spread playing catch up to the US bond yield. Okay, so we've certainly seen a narrowing of that spread. Now that should be Euro positive, but it wasn't. Euro went lower in here. So, but what we've certainly seen is European indices got significantly hit yesterday and back lower again in here today. And what we saw was, I honestly believe that was the trigger that took US stocks lower initially in the session and then a rapid sell-off. Now we've got all sorts of, I think this is lazy journalism, right? Wall Street drops as investors, jitters climb before CPI. It may have been a bit of position squaring, yes, ahead of CPI, right? But I think the negative tone in here was really laid down. And then this overnight in the S&P Dow futures dip ahead of monthly. Yeah, so I agree that this morning and maybe that late sell-off, I think the initial driver, the initial thing that spooked market was the ECB, even though they'd flagged that they were going to be more flagged that they were going to remove the quantitative easing, which they are going to do from the beginning of next month, from July 1. And then also they've really signaled a first rate hike in July and maybe more aggressive rate hikes going down the line. So all of that in here. So here's an article in here on Reuters, ECB, where as it signals rate liftoff, eyes bigger move in September. So basically promises a 25 basis point July rate hike, says we'll hike again in September and bigger moves possible. Okay, and they also did away with they started to unravel their quantitative easing that is going on. So all of that, I think if anything, they were a little bit more hawkish than the market anticipated. Now, usually that would be better for the euro, but the euro actually went lower in here. But even euro lower should help European stocks, and it didn't. European stocks got hit on this just because I think the markets, really, and then obviously bonds, as I said, bond yields in Europe plunged significantly lower. So that's lower. Sorry, not bond yields lower, excuse me. Bond prices went significantly lower prices, higher yields, and the spread narrowed to the US. So the European bond markets have led markets lower, the bond markets lower over the last week or so, and certainly yesterday. They were the more aggressive movers than the US bond market, which tells you that they're playing catch up to the US, which we kind of know, but that was delivered yesterday. And I think now that we have global central banks, the ECB, apart from the Bank of Japan, ECB has been uber dovish, have stayed dovish, pretty much this century, to be quite frank. Certainly in the wake of the global financial crisis, they've been very, very dovish. And now we've had a shift, the first shift, obviously the first rate hiking cycle for many years, in over a decade. And then also in here, we've seen them move to a position of probably a little bit more hawkish than the market was expecting. And I truly believe that was one of the significant triggers for the US or the global equity market setup that we saw yesterday, and then exacerbated by, as we were going into the close, we then made technically, which will come to the chart shortly. Technically, we made some negative signals as well that the markets are putting like topping patterns. They broke down through significant support levels on the Nasdaq and the Dow and the S&P, and that meant that then going into the close and going into obviously into today's CPI data. And remember, the CPI data is going to be out before the cash market opens. We saw a little bit of running to the hills, so we saw liquidation of positions in the cash market, which drove then the broader market lower in here. So I think that was the core reason for yesterday's sell-off, the driver of that. and also in tandem with the fact that we had CPI upcoming today. It's going to be critical today, and the markets could be 2% up or down after today quite easily. So I've got no strong view. The bearish signals yesterday. If we didn't have the CPI today, I'd be running into the day fairly negative, which I'm not normally that negative. I'm kind of got a bullish, mostly got a fairly bullish hat on. Certainly, I think I've got more of a bearish hat on in here. I would have, but then you're going to have to play it by what we get from the data. What else do we have in here? Outside the US, fragmentation is the word of the day. Euro area peripheral was led by Italy and Greece are selling off again this morning. So bonds in here, bonds going lower. Okay, and we're seeing a widening of spreads in here, widening of spreads as we're seeing, obviously, European government bonds in here more aggressively sell off in the periphery, which is, let's say, Italy, Greece, etc. They're leading the way lower, so we're seeing a widening of bond yield spreads. Say Italy versus Germany in here, so a more aggressive move to higher yields for the periphery of Europe. Okay, on the back of the ECB. Riot hearings are going on. I don't think that's going to impact us in any way. What we're trading in here, futures markets in a narrow range on Friday, but slightly more negative. And then the focal point, as it says in here, is the CPI data. We do get further data this afternoon. I think we get Michigan consumer sentiment. That's 10 a.m. Eastern. Probably not going to have a massive impact given we've got this big data ahead of it, the CPI data. But we do have ECB's Lagarde speaking. She may in here give us something that we didn't get yesterday, but it's doubtful she's going to say something that kind of dismisses what we saw from yesterday's press conference, right? Okay, that's 5 things to say today. We've spoken about the ECB with futures are mixed before the open, CPI report, obviously. And we did see China, actually, Asia was up, China's stock. So Asia's stocks were down with US stocks being down. But Chinese tech shares again pushing higher in here. They have been pushing higher over the last week or two. And Chinese stocks up partly on reopenings. I think there's another article in here on Chinese stocks on reopenings. China market springs back into action as COVID lockdown. So reopenings, COVID lockdowns easing, plus tech stocks leading it higher, the growth stocks leading it higher as we do reopen. Plus we have also seen that positivity by the institutions, the authorities seeming to be less stringent. We had a kind of a crackdown on tech stocks over the last year or so, seeming to back off from that. And then we spoke about the Ant Group in here, maybe the IPO coming back in here. So all of that signaling a positivity for Chinese tech and the Chinese market broadly. However, it's not done enough to kind of raise global European and US stocks this morning. So Wall Street drops. That's a bit of lazy journalism, in my opinion. It probably was some positioning squaring. S&P Dow futures dip. Well, therefore, go and take a look at where we actually are now going into the day. So European stocks, you can see 1 to 1.5% lower. Remember, they missed some of the sell-off that we saw. Obviously, a lot of that sell-off that we saw yesterday in US stocks was in the late session, okay, going into the close in the last 1 to 2 hours of trading. And European stock indices in here, the actual cash markets, the futures markets are open, but the cash markets were closed. So these are playing catch-up. So part of these percentages down are playing catch-up with yesterday's moves lower, late moves lower in the US. And then obviously US, we were down 2% in Dow, and then let's say 2.5%, I think it was on NASDAQ. And then this morning, we're kind of unchanged. You'd have to say this is not really, we're 2/10 down on the S&P, 2/10 down on the Dow, S&P is flat, 2/10 up on the NASDAQ in here, or this is last refresh on this. Nothing really to add on this. We've been talking about this a lot, but basically nailed on for 2 rate hikes in here. If anything in here, if you see now into the July meeting, we've got increased chance in here. So in here, we're currently 75 to 100. Okay, so this is pricing in a 50 at the next meeting, middle of June, which is actually actually next week, right? Oh yeah, Fed's next week. Sorry, yeah, Fed next week, middle of June, pretty much nailed on 50. But then going into the July meeting now, this is rising. Okay, so more of a chance. This is pricing in 50. And so this is pricing in maybe a bigger hike in here, and maybe that's to do with the fact that the ECB, this is like the rise because the ECB have turned a little bit more hawkish. Okay, and then we go to September and it's pretty much as it has been. That's another 50, and then in here pricing in maybe or a total of 70 and a 50. A total in here of 350s in here, with the outside chance of maybe less, but an outside chance of also more. Okay, let's go take a look at some charts. I'm going to start off with the Nasdaq because it kind of led the way down. We had these multiple support areas. So part of the thing was we saw the ECB, I think, initially drove the market lower. And then when we went to late trading, we went down. We'd gone down through these support levels in here, and then that encouraged that late sell-off in here. So if we go and step into like a 15-minute chart on the Nasdaq, we spoke about the market being in this bigger range. You're going to get rid of all this old analysis. It's kind of irrelevant now. So there's the bigger range in here, been chopping in this range, but underlying theme, bullish. We spoke about this yesterday. You got this underlying bullishness from the rally that we saw in the latter part of May, going into the end of the month, and then we're kind of been choppy through early June, but it repeatedly rebounded. So in here, it's rebounding in here. It's repeat rebounds from these supports, and then obviously we plunged down through that. Remember that didn't come till the latter session. So after the ECB, if we're going like ECB, we were, where are we in here? 9th, 12th. So I'm just going to get the right time here. So this was ECB. Okay, so the market initially sold off on the ECB and then held. But then as we go into the afternoon session, it starts to sell off. European markets close. And then it's really, I think, when then we break these supports. And once we break these supports, then you really start to get the acceleration into the close. So we get some panic going on, probably ahead of CPI with some position squaring as well. But I think the trigger really came from ECB. We got kind of sell off after the ECB. The market bounced here. This is the cash market open in this bit here. So the cash market open, we get a relief rally, and then we just went lower and then accelerated as it started to take out the low for the day, and then these lows over here from the lows from the month. Okay, and then we saw the acceleration lower. So where do we go from here? Well, you know what? Overnight, paralyzed really overnight, just completely sideways. Sitting down on the pretty much where we closed. We said we're hardly up or down in here, and I think you just react now to the data. You do have some support over here. Now I'm still running this the June contract. Now we are at the point of rolling. You could argue you can be trading either of the contracts in here because you've got liquidity in both contracts. I think now we actually are on September as the front month. But saying that, I'm just going to go and check that off screen in here. But I'm still looking at the June contract in here. You could be trading off of either one in here at the moment. Yeah, I mean, a lot of it's up to you really. The liquidity is in both. I'm still staying with June in here at the moment, but you can see on the June in here we've got this little low in here. Now this is from, just so you can get it if you're looking at the SEP, it's from the 27th of May. I've got that little low in there at 12,222 actually on the June contract. Down through there could easily be your next trigger for the downside on the data. Upside, probably, I wouldn't probably just go with a break of the range highs. I'd want a bit more than that, really, the trigger level. So the trigger level was the previous low. So up through there, the previous low, which triggered the acceleration lower. That low 12,412.5. So maybe waiting for a break above there. I think there's going to be a lot in this today. You don't have to be. I'd be waiting. My advice would be wait for confirmation. Don't jump straight in on the data. You could get revisions to the data. You have to be careful with that. You've got, remember, you don't only have CPI and core CPI. So which one is the market going to react to? They could be in opposite directions. You've got month on month and year on year. So you've got 4 pieces of data there anyway. Month on month and year, that's 2. And then you multiply that by core and just normal CPI. So that's 4. And then you've got revisions to last time's data. Okay. So then you've effectively got potentially 8 pieces of data. Okay. So the algos will go in, they could chop you up. So I would wait for confirmation, because this is got potential to be, like yesterday, a 2% day on the S&P and a 2.5-3% day on the Nasdaq. So you've got plenty of time to wait and get confirmation. So don't just necessarily jump straight in, because you could get whipsawed and chopped out of any position. We could easily up here and then back down. You could be making highs up here, above the overnight highs, and then it could be back down here, within seconds. So I would be holding off, waiting for confirmation. I would strongly recommend not holding positions into the data. You may as well just go down to the casino if you are going to do that. Let's go to the S&P, and it's a similar story in here. So again, took out this set of lows in here from June. We have this cluster of lows on the June contract around 40, 70, kind of 71, 70 kind of area. And once it broke there, then we saw the acceleration. It's a similar story, obviously. It's kind of, and then we spoke about yesterday this kind of triangle, this kind of bigger consolidation pattern. And the market, obviously, look, when we broke down through there, you really saw the accelerate. It chops as it breaks down through there. And then when it breaks down through here, it really accelerates lower. And remember in here, again, on the data, so in here, this is the ECB initially, it sells off, then it pops on the cash market open, and then eventually, boom, breaks lower, and then just sitting down here. And actually, if anything, drifting slightly lower in here, looks vulnerable again. And going across on the June, let's just have a quick look to see. No, we're actually down through this. That's the equivalent level. So more damage done in here. So you haven't got any real trigger point on the downside in here to really go off of. Maybe down here, this is from the 26th of May. You've got a spike there, or you'd be looking at a Fibbo retracement from the whole up move. Okay, potentially looking at that. Let me get rid of all the old. And remember, this is on the June contract. You may be looking at the. So I'm just going to zoom out a little bit. I think that's the whole move. That's the bottom there, isn't it? So I'm going to take the whole up move and put the fib on of the whole up move. See if that gives us anything as a trigger point on the downside where we might feel that the market has done its stuff. Oh, that's really interesting. Look, we're at the halfway point. We're sat right at the halfway. But you could obviously do the same on the September contract. So this is from the low on the 20th of May through to the high at the end of the month at the 30th of May. Okay, the 50% retracement, and we are holding. We held there pretty much to the tick in here this morning. So down through this morning's low would be a bear trigger. Now, obviously, you're going to wait and see. Okay, you're going to wait and see whether on the data we get a proper breakthrough there. Not going to necessarily sell on a break straight through the low, but if it goes through that low, then it's also through, as I say, that 50% retracement. That's a really bearish signal as well. So if it goes through and stays there, whatever your strategy, I'm not going to dictate your strategy, but through today's low in here, which is at 4,006, right? So if it breaks 4,000, you probably think and stays below 4,000. Again, depends on your strategy and your holding period, whether you're kind of scalping and you're in and out in minutes, or whether you're looking for, a 30-minute or 1 hour, 2 hour move. I don't know. You're going to obviously want more, the longer your holding period, the longer confirmation you want. And also then obviously the bigger target you're going to have. But, I would say through 4,000, holding below there. If it holds below that, certainly after the data and running into the cash market for an hour after the cash market open, or you might want to do it, much shorter period than that. You might want to do it after 10, 15 minutes. You have to just be wary that the market often reverses on the cash market open, as you will be very aware. Okay, let's take a look at the commodity markets. So oil, I'm going to got it on. I'm going to go to oil first of all. So oil strong like bull, really not reacting at all to the recent price action we're seeing on stock indices in here. A high level, I would class as high level consolidation yesterday. Very narrow range for oil in here, and just up at the top of the previous session's range. And then this morning, dip in a rebound, okay, in kind of European hours. And if we go and step into the 15-minute chart, you probably had your buy opportunity. So look, remember we looked at this yesterday, this counter trend line. The market kind of stayed below that because we're in consolidation yesterday. Even if you redraw this one, you can just redraw it and take it out through these peaks here. You can see, and it kind of respects it. Let me see if it'll allow me to do that. No, it's not going to allow me to do that. Sometimes it allows you to pivot. I don't know why it doesn't always allow you to pivot. I think you have to grab. There you have to grab it dead on. But then this looks like a really good trend line. You can see we went up, and then overnight in here, boom, up through. So really solid. Or this morning actually, up through there this morning, taking out various peaks in here. You get a dip opportunity in here. So maybe buying this little swing in here on oil, depending on your strategy. And then gold in here, dull. You did get a dip and a rebound. Lower in here this morning. This is going lower with, if I just step across and go and look at the dollar is strong again. Big update for the dollar yesterday as we went into risk off, stocks down, dollar up in risk off scenario. So a really strong day for the dollar yesterday. Euro dollar was down. That makes up a big part of the dollar index in here. And then higher again in here. So the last 24 hours of gains in the dollar weighing on gold. Remember, inverse relationship between dollar and gold. So gold down in here is taken out this week's low and now is eyeing the low here. It's a very negative candlestick already on the daily. And if we go to the 15-minute, look, we've just had this plunge. It's just happened actually in the last 30 minutes. So maybe some position squaring ahead of, and we've taken out the low there. So this looks pretty negative. Probably won't want to sell right here, right now, given the last two. This is 15-minute chart, the price action of the last half an hour. But any rebound into the data might want to look to sell into that as we go through the data, or again reacting to the data, because on a bigger picture that looks quite negative. Okay. All right, I'm going to wrap us up there. TGI Friday and all that. Have a great end of week. Have a great weekend. Helmets and goggles on for CPI. I would strongly suggest no positionings going into the data. React to the data. Give yourself some time to react to the data. A little bit of patience today. Watching you don't get whipsawed in or out. And then, I will be back with another bull versus bear webinar on Monday. Have a great weekend. Take care.